Good afternoon and welcome to the Wall Street Crossover Show featuring Darren Sinden, who is the market commentator for Admiral Markets, who is also the sponsor of this show. Good afternoon, Darren.
Afternoon, Zach.
Right. Another day goes by, another day closer to the big day, which you're not that interested in on Thursday.
Well, I mean, obviously, we pay attention to what happens and what the Fed says in any post-decision statement. But the truth is, we don't think that they're going to move on September. Well, in fact, in the show today, we'll look at one of the reasons why we think that's the case.
Okay.
We're not agnostic to the idea of a rate rise in the US at some stage. We think that's inevitable, but we don't think that there's any need to rush for a variety of reasons. Not least because once you start on the upward path, if they found that they needed to retrace and to do an about face, shall we say, would find it very difficult to do that, and it would likely be ineffective to cut rates again after you've raised them. So
okay, well let's look on to the normal proceeds, which are starting off with data released over the European session.
Okay, well, first of all, we had a raft of inflation data from the UK, in a variety of measures. I've picked out just three of the data points here. So first of all, what on the face of it looks quite positive, although it's the retail price index, the slightly discredited version of inflation as far as the powers that be are concerned. But UK RPI for August up 0.5%, ahead of the forecast of plus 0.3%, and well ahead of the prior read for July of minus 0.1%. So if you're the Bank of England, the MPC, you're looking to try and stimulate inflation in the UK, you'd take that, I think, as a positive read. Then if you look at CPI, that's one of the preferred measures of inflation. This is a number for August. Again, this time we look at the year-on-year data. No change. 1% is what we came in at. That was exactly in line with the forecast of 1%, and in fact, slightly weaker than July's 1.2% growth. So conflict, I suppose, between the RPI and the CPI data there. But then if you took a step back and looked at some of the PPI data, this is a data point probably very few people look at any great depth, but this is UK PPI input prices for August. This is on a year-on-year measure, so this August 2015 versus what things were like in August 2014. And look at that, minus 13.8%. So factory gate, so the input costs of goods and services the factories are buying to make things are down 13.8% over the prior period. That's slightly worse or better, depending on which side of the line you stand, than the 13.5% fall that was forecast, and the prior read in July of minus 12.4%. So on the face of it, reduced input prices sounds good because it should mean cheaper finished goods and services to consumers, and in the short term that's possibly true. But what it means longer term for businesses is running down of inventories, no reason to hold stock, problems along the supply chain, because why would you hold on to something that could devalue 13.8% in a year? So that just shows, I think, the task the Bank of England have, and how difficult it is to square this inflation circle, and why interest rate rise decisions are so problematic.
Well, the other point is that the manufacturers or somebody doesn't seem to be passing on this wonderful cost saving to the consumer.
No, so that might be good for margins in businesses, and therefore perhaps for shareholders and their dividends. But it's not, as you say, not necessarily being reflected in prices to the underlying consumer. And if we then jump over the channel and look to Germany, we had the ZEW surveys out for September. I've decided to look at the economic sentiment number for September, and the read came in at 33.3, well below the forecast 42.1, and again sharply lower than the prior month's 47.6. So I guess it's not surprising that economic sentiment should have taken a bash after the last 4 to 6 weeks that we've seen with all the upset in China. Nonetheless, it's a very sharp deviation from what was forecasted, and obviously an even bigger one from the prior positive read of 47.6. So lots for the German economics ministry to
I think it's amazing. I don't think I've ever seen such a big difference in the number month on month. So you would have gone for 42.1 just on the basis it's 5 points lower, but that's about the most you would have gone for really there. But Okay, well, let's go on to the European movers.
Okay, well, we're back in the utility and power generation space with E.ON, ticker EOAN in Germany. We talked about these only recently, but further bad news. You might remember that they abandoned plans to spin off their nuclear power business. They're trading at €7.96, down a further 7% this morning. The reason why is that the German press have suggested that the generator may need up to another $30 billion to pay for its nuclear storage issues and the nuclear legacy. And of course, the German government are talking about inextricably linking the legacy issues to the original owners. So that's not something it would appear that E.ON or even RWE will be able to avoid. So a very negative price move there, and hard to see an easy way out of that situation for them. And then something slightly more positive here in the UK, Thomas Cook, ticker TCGLN, 116.5, up around 2.14%. Now, obviously, Thomas Cook is a travel agent, had a very difficult few months. Obviously, not only the atrocity in Tunisia, but all the bad publicity associated with the lack of an apology over the deaths in Crete. But there is some positive news finally from shareholders. The stock's higher on talk that China's Fosun, which is one of China's largest privately held conglomerates and is a 5% stakeholder in Thomas Cook, is interested in further European acquisitions. Whether that's to buy Thomas Cook outright or whether it's to use Thomas Cook as a vehicle to buy other European travel businesses is unclear. Nonetheless, a small boost for the shareholders there.
Right, good news there. M&A rumours and movers.
Right, well, really just an update on something that we've talked about a number of times over the past few weeks, and that's the potential tie-up between Vodafone and Liberty Global Media. Vodafone trading around 215.5, down 2.6% this morning on the back of comments that were attributed to John Malone and Global Media, or Liberty Global Media, sorry. And the comment basically was that they've been unable to reach an M&A deal with Vodafone. Perhaps not so surprising, given that Liberty has expressed mostly interest in asset swaps rather than an outright bid for Vodafone, and that those swaps or the proposals there have basically seemed to offer little in the way of tangible shareholder value for Vodafone shareholders. Liberty maintain that actually the deals they want to do are good for both sides long term, but I think shareholders would like to see jam today. Just to remind people, Vodafone is the world's second largest wireless carrier when it's measured by customers. Having said that, sizes and everything, its shares are languishing around a 3-week low. What struck me as being interesting and perhaps slightly odd, reading the subtext of the Liberty Global and John Malone comments, is that Liberty Global itself might be amenable to selling itself to Vodafone at the right price. So maybe there was never a real deal on the table. Maybe it's a bit of reverse psychology from Mr. Malone. If the two did merge, i.e. Vodafone took over Liberty, then we'd have a group with $80 billion in annual revenues and $130 billion in market cap. So it would be a substantial business. But it's just, as I say, it looks like a way. What we need to do is find out the best way for these two groups to get together, or perhaps part company and never speak again, which might well be the end result.
That sounds very cruel. I think they should just merge and get on with it. Or get on with it, merge rather. But we'll see what happens there. I mean, I think the hot money got out of there quite a long time ago on Vodafone, 220, 230, so,
Yeah.
Or 230 plus, in fact. So the story seems to be killed off by people. US data points.
Okay, well, it's slightly full of calendars today, so a bit to get our teeth into. First of all, industrial production for August, the month-on-month number, forecasters show a small decline of 0.2% against the prior gain of plus 0.6%. Then we have retail sales for August, again the month-on-month number, look for a modest gain of plus 0.3%. Now that's only half of July's plus 0.6%. And then the Empire State Manufacturing Survey for September. Now when this came out last time, it was a massive shock. Today we're looking for a small drop of just 0.5. We're only looking for a modest change last time out, and we got a drop of 14.92. So I'm sure that one will be closely followed, just to see if there's not another large swing in either direction. But probably the industrial production and the retail sales numbers will have more bearing on people's sort of trajectory, shall we say, for interest rates.
as long as the Empire State doesn't come in with another massive horrible move.
Another big drop would be a cause for concern. That's certainly true.
Right. Okay. Well, let's go on to the pre-market movers and levels.
Okay. Another stock that we've mentioned recently was Chenery Energy. That's ticker LNG US, trading around $55.05 pre-market, up by 1.68%. Why I thought this was interesting is that Carl Icahn has increased his stake. He had 8.18% last time he updated us. Now that's increased to 9.59%. Chenery is a liquid natural gas storage and transmission business. Mr. Icahn has agreed to certain terms for his board representation, and he can't directly get involved in a proxy war, I believe, under the agreement. However, having said that, I'm sure he's quite capable of shaking the tree further, so I imagine that will be one to keep a close eye on. And then our second stock to look at today, Fiat Chrysler, that's FCAU in the US, $14.56 pre-market, up about 1.6%. And I think they're better basically on the news that European auto sales rose just under 12% in August, according to data released today. And it's obviously the start of the Frankfurt Motor Show as well.
Quite an achievement, I would say.
Yeah, no, I mean, it's a tough time for automakers in China, but European numbers still seem to be heading in the right way for now, at least. And in terms of levels to watch in our cash equity markets today, FTSE a little bit easier along with the rest of Europe, so 60-20 now plays at 6,100. Of course, that 6,000 handle is edging ever closer, a psychological level if nothing else, and if we were to break below that, that might be a catalyst for a further or a bigger move downwards. The DAX itself is testing back towards 10,000, so we're looking at 10,070 now, plays 10,200. In the US, fairly weak price action overnight, so we're 1948 as a support level now, and the S&P plays 1965, which we need to break above to make better or newer highs. And for the Dow, 16,330 plays 16,470. Again, not expecting too much action ahead of Thursday's decision. And in the currencies, the euro remains relatively firm against the dollar, 112.93 on the downside now, plays 113.17 to the upside. The Aussie dollar, US dollar remains firmer on the news of a change in the leadership at the top of Australia's government. 71.12 now, our downside level, plays 71.35 to the upside, so we've managed to tighten that range up quite nicely.
Bizarre events in Australia.
Yes, 6 prime ministers in 8 years. It's almost got the smack of Italy about it, hasn't it?
Will be coming round to us soon, won't they? Right, on the dollar yen.
Dollar yen. Okay, back below 120. The Bank of Japan didn't ease and didn't give any indication of easing, though the market still thinks, like I do, that October's the month for that. 119.20 then, the downside level to watch there, plays 119.80 to the upside. And cable, a little bit better again, attributed really this gain today to the inflation data, though, as we've seen. I'm not sure that really stacks up, but perhaps a bit of position squaring ahead of the FOMC. But 154.10 now on the downside, plays 154.75 to the upside.
Right, to finish off in focus, we've got the US economy.
Yeah, so alongside the industrial production numbers today, we will get some other interesting data. So the question is, what are we watching? Is the US economy firing on all cylinders? So yes, the US economy has been recovering, but the recovery has been patchy over the last year or so. And one statistic which can provide a clue to the strength of the recovery is capacity utilisation, and we'll get that number out today. The capacity utilisation measures the percentage of the potential output levels being used within an economy across 81 industry groups. So it's quite a broad measure, and it's basically, I think, a decent guide as to what's going on in the underlying economy. To date, for this figure, we remain below the high levels seen in November and December 2014 at 79, and this is the bar chart of capacity utilisation. We've overlaid it here with US factory orders just to give a bit of context, but we can see that the trend remains sharply lower. The forecast for today's figure is 77.8, which is down from last month's 78%. I think the key thing here is that capacity utilisation in the US has averaged 80.49% over the longer term between 1967 and 2015. So not only are we below the recent historical highs, but we're well below the historical average as well. So there's some way to go, to my mind, for this figure. Why do I think it's important? Because I think if you think of an economy that's growing, you would expect to see demand, and you would expect to see the amount of capacity, at least in this, or being utilised, at least in the short term, being picking up until such point as additional capacity, of course, could be added. And we haven't seen that. And until we do, I'll remain sceptical about the long-term health of the US economy.
Does that also suggest that in this chart that the best part of the the post-financial crisis time was last year, and we've sort of really basically lost the momentum since then?
Yes, yeah, absolutely, and that maybe the window of opportunity to tighten rates is narrowing, and may have really, to do it most effectively, has possibly passed the Fed by. Yeah.
Yes. Interesting. Well, as I said, we'll find out very soon. Darren Sinden, market commentator at Admiral Markets, thanks for speaking to us today. We'll be back with the Wall Street Crossover Show 1 p.m. tomorrow.